All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Been an interesting week in the market, and it's one where most weeks we don't have anything that's game changing. We don't have anything that you look and go, well, the conditions of the market have changed dramatically. We don't have that most days, most weeks. And I know it's what traders look for. It's like, well, when something major happening, and okay, now what do I do, right? That's kind of the typical thing for traders, investors. When the answer 90% of the time is nothing's changing. It's the same thing, but is stick with what you're doing and go. But this week is different. This week is different. And as I sit back and watch and observe, and as I go and make a few adjustments to things, I can't help but wonder if we don't look back at this week in the market as a major point in the years to come. And we've had a few of those kind of time periods in the market. Things like a flash crash and things like, the day that Angela Merkel, went out to a different restaurant, and we saw Greek bonds collapse because of it, and put a bottom in the market, and we see things like a U.S. election between President Trump and Hillary Clinton, creates some game changing type of action. And this week we have just seen something that we haven't seen in a long time. And we're seeing price action that we haven't seen in quite some time. And we are seeing some movements that are, wow, in both directions, right? In both directions. Let's go out. I'll give you my thoughts on the long term, short term of this market. But I want to go start out with the current yield curve. Okay, now before we do that, I have a sell signal on Caterpillar, a put signal on Caterpillar. It was down about $1.30 at the open. I was looking to get in right then. The spreads were just a little too high. It is based on a daily chart breakdown below 132, so I'll wait till closer to the close, to see whether I can pull the trigger on that or not. But just so you're aware. But I'm not looking to enter anything, right here. But yield curve, right? Yield curve is this kind of funky thing that if you're not involved in the market, you don't really care about, or if you're not a banker, you don't really care about. And, even if you are involved in the market, even if you are a banker, you're not really caring about it all that much. It's not something you stare at every single day. My uncle was a banker, and, every day, that I saw him, the topic of conversation was, what's going on with yields, right? He's who I learned bonds from, and, that was the topic of conversation. But for most people, that's not the case. A yield curve is this very simple thing, and I put a training yesterday in on the yield curve, one that I had done, a few years ago. But a yield curve is just taking a look at the different treasury yields on different time periods and what is the interest rate. When you use the term yield, it's basically the rate, okay? And you can see this yield curve up here, where we have the 30-year rate right back here, and we have the short-term yield right here, right? The 3-month, then we have 2-year, 5-year, 7-year, 10-year, 20-year. Banks basically make their money by lending on the back end of this curve, home loans, business loans, auto loans, that type of stuff, right? And basically borrowing money at the front end of the curve, checking accounts, saving accounts that they pay, a little bit of interest, CDs, that type of thing. So banks get money in, they're paying the front end rates, but they lend money out and they're making the back end rates, and that's how they make their money. Now there's other ways and other things, but that's kind of the gist of what banking has been for, 100 years. So why does the market care? Why do people care about the yield curve, and why does it matter right now? Well, because historically, when the economy is growing and expectations are for further economic growth, the back end of this curve goes up. It rises. There's a demand for money because they know they can put that money into play, see the growth, and there's this kind of just overall demand for money. When the expectations for economic growth in the future go down, the back end of the curve tends to go down. Now everyone thinks, the Fed, they have control over this curve, right? Well, no. What does the Fed do? They adjust the front end of this curve. That's what they do. They can raise it and they can lower it. Right? Fed has been in a tightening phase, a phase where they have been raising short-term interest rates. Well, look at October 2016. Short-term, it was down here at 0.25%, right? Back end was up here around 2.4%. There's a big difference there. There's an area for banks to make money, right? They can lend it for pretty cheap. They can borrow for pretty cheap and lend for, relatively more expensive. But if you look, what has the Fed tightening done? The Fed tightening has pushed the front end of this curve up. We saw a little back end of the curve rise back in 2017. But here over the last while, what's been happening to the back end of the curve? Well, the back end of the curve has been pretty much staying the same, right? It's been pretty much staying the same while the Fed has pushed the front end of this curve up. What's this mean for banks? What's it mean? Well, really tough to make money. If banks are going to have a hard time making money, do they want to lend? What happens to their lending practices? Are they as eager to lend? No. And so what happens is there's less lending, less borrowing, less money flowing through an economy, which creates a contraction in the money supply, which ultimately leads to economic deterioration. Fed knows this. They're aware of this, right? They're well aware of this. They pay attention and watch this. But when you look at every major market collapse or market bear market historically, they all have one thing in common. They all have what is called an inverted yield curve. An inverted yield curve looks like this. Here in 2007, take a look at the front end here in March. The front end is up around 4.8%. The back end's at 4.7%. Banks have incentive to lend? No, not at all. Right? Not at all. They're not going to make money. No, they're not going to make money. You say, well, why does this happen? Well, because the Fed interest rate has been propped up, right? That front end, but that's controlled by the Fed, has been kept up. But the back end, they're not pricing in economic expansion. They're seeing issues on the horizon. This happens before every major massive sell-off. We saw it happen in 2007, 2008. Now, what also happens is we get an inverted yield curve, and then the market goes to a new high during that time. Here we fast forward a few months here in 2007, right? Let's get to October of 2007 here. Here's October 2007. Notice what happened. The back end of the curve stayed the same. What happened to the front end? It dropped. What happened? Fed lowered rates. The Fed said, hey, this inverted yield curve's trouble. We got to lower rates. They went to a dovish position. The yield curve had been inverted to flat for almost a year before the Fed took action. You look here back in 2000. This is 2006, August of 2006, inverted yield curve. Look what the market did after that. Market went up into new highs. Said inverted yield curve be damned. Why do I show this? Well, I show this to show that the inverted yield curve is a very dangerous sign and historically has very strong ramifications in terms of what happens to the market over the long haul. In the short run, though, do you look and wake up and go, the yield curve is inverted, sell everything? No, not at all. Not at all. In fact, most times when the yield curve inverts, there's another significant time period for the market to rally. Right? Here's back in 2000. Right? Now we still had 6-8 months of rally come into play. Yield curve inversion started becoming a big concern and worry back in September of last year. And we're 6 months away. Right? We're 6 months away. From a historical standpoint, we could still see 6 to 8 months of rally just simply based on the based on the typical time frame when the yield curve moves. But something happened here in October of 2007. Market hit a brand new high. And the day that it hit a new high, I was back in Pennsylvania and was with my brother. We were back there, and market printed a brand new high. Had CNBC on, and this economist jumps on and says, "Yeah, the data is getting a little bit worse, but not to fear, not to fear, because this, that, and the other are going to cause it to improve going forward." There was a rationalization for the data and the earnings to improve going forward. There was a rationalization of the yield curve. Why do I bring this up? Because today, we have a yield curve that's not fully inverted, but is partially inverted. And if you look in European markets, we have, inverted curves around the world. We have growing economic headwinds. We have growing earnings headwinds. Go take a look at Adobe, FedEx, Nike. They're decent earnings, but there's some fear about the future in those earnings. And it's all being swept under the rug. It's all being rationalized. It's all being said, hey, when there's a trade deal with China struck, things are going to get better. So this weakness in data isn't going to matter. The weakness in earnings isn't going to matter. And the weakness in earnings is relative weakness. It's not we're not talking about big bad bear market earnings, when it comes down to it. There's some general positives in the earnings. But there's a rationalization that's going on out there. And on Wednesday, why I think this week is a huge week for the markets is we saw the Fed come out and do what they did here in 2007. They bent to market pressures and said, fine, we're going to change our stance. We're going to go from general tightening to neutral to just absolutely dovish. And you know what? We'll give the markets whatever they need going forward. Bernanke, this is when he took over. And yes, in the first 6 months, he looked like he was in way over his head. Ultimately, will probably be remembered as one of the most brilliant Fed governors ever, or Fed chairman ever. But initially, wow. But the Fed conformed there to the market. Did that drive the market higher? Yeah, it did for about 2 months. Drove the markets higher. Markets went and hit a new high here in October. Fed lowered the rates. Yield curve. All right, we have a decent yield curve now. Time to go higher. No, didn't materialize that way. Didn't materialize that way. Why? Because some of the risks were ultimately realized. Some of the risks were realized, and there was a great unwind in credit. When we saw the top back here in 2015, there were a lot of people calling for big bad bear market. This is the end, everything. But look at the yield curve back then. Look at the yield curve. Pretty bullish, right? Come right here into 2011 when there was the Greek Euro crisis, flash crash, that happened in 2010. We had pullbacks in the market, but look at the yield curve. The Fed used quantitative easing to create this curve. Bernanke was very conscious of the need to have a strong yield curve to weather through some of the turmoil that was out there. The market does not have that anymore. The market had it last year. It's had it for quite some time. But the Fed tightening has essentially done very little to push the back end of the curve up and a whole lot to push the front end of the curve up. So the Fed has created this much flatter yield curve overall. Some argued that when the Fed started its tightening process that it would be like pushing on a string, that they would push this front end up, but it would have no effect on the back end. The Fed argued that no, it would. Because of X, Y, and Z, no, we'll see the back end rise. And, there's been a token rise in the back end. But overall, it's been like pushing on a string. And they've essentially flattened the curve. When you hear U.S. President Trump commenting out against the Fed, against them raising rates, this is one of the reasons. When you have the market throw a little temper tantrum about the Fed wanting to continue to raise rates, this is one of the big reasons. I mean, what if the Fed were to continue to raise rates throughout this year and pop the short-term rate up here to 3%, and the long-term rate is down here at 2.7, 2.9? What happens then? And the Fed basically on Wednesday said, all right, market, you win. You're right. We've been pushing on a string. There's now economic risks, and we're going to stop pushing on the string. And you know what? In fact, don't even worry about us messing with rates for a while. And, if we need to, we'll actually go the other way. Very similar fashion here to 2007. Very, very similar fashion to 2007. And the yield curve looks very, very similar, albeit at a different ultimate level. The meaning of that we'll talk about some other time. It says nothing about the short-term market, about the market's ability to hit a new high, the market ability to drop. But it says something about major components in the market. And what do I mean? Well, we talked about this the afternoon the Fed, made their decision. We talked about just the absolute change here with the banks. Basically, the banks and bank investors had to deal with what? The back end of the curve coming on down. Take a look. In fact, let's come here to look at it a little bit different way. But the yield curve, from the Treasury. This is just going to be numbers from Treasury.gov. And here we are with just pure numbers, right? And it's not showing it in a graph form, but here's the 1 month, 2 month, out to 30 year, right? And it's showing the 1st of March down to the 21st of March. When the Fed made their decision this week, what happened to the short-term rates? I mean, they basically said, hey, we're not going to raise rates anymore. But what happened to the short-term rates? Did they go up or down? They went up to 2.5. It's the highest short-term rate that's been. What happened to the 2-month rate? Not much. Not much. But notice now the 2-month rate is actually lower than the 1-month rate. We've seen this happen a few times. But most of the time, you look back over the course of this month, that's not the case. We saw it, a week ago. But then you go out to the 3-month, 2.49. 6-month, 2.5. 1 year, 2.48. So it is cheaper to borrow money for a year than it is for a month. That's yield curve inversion. 2-year, 2.41. 3-year, 2.34. So basically, you can go borrow money for 3 years at a cheaper rate than you can borrow it for a month. You can borrow it for 5 years for a cheaper rate than a month. You can borrow it for 7 years for a cheaper rate than a month. Once you get to 10 years, that's when it gets more expensive. But look at the absolute front end and the back end of the curve over the last 2 or 3 weeks. The front end has gone from 2.4 up to 2.51. The back end has gone from 3.1 down to 2.96. The Fed's ultra dovish actions on Friday only say, hey, we're going to keep this front end the same. And you know what? There's a lot of risk going forward, so you may not want to pay up as much on the back end. And natural market forces take the back end down. You'll notice the 20-year, you'll notice the 10-year, you'll notice the 7-year. They're all at new lows for the month. All at new lows for the month. And so the Fed action in their comments, what is it managed to do? It has managed to further flatten the yield curve. This is not a fully inverted yield curve, right? Where the front end is higher than the back end, but there's inversion within this curve, right? The inversion is from the 2-month here to the 5-year or 7-year, excuse me, right? This whole middle section is inverted. So it's not a full-on inverted curve, but the middle section is. That's what the Fed has done. That's what their actions have done. What's that mean? Well, this isn't going to be enough to, in and of itself cause the market collapse or in and of itself to, send things, down in a huge, huge way. But it is enough to tell investors this is not a short-term issue. This is not something that, this is just a piece of retail data. It's just bad this month. It'll improve next month. This is the Fed looking out over the course of years and going, man. So what do we say? Well, we see the reaction to the banks. Why? I mean, why would the banks sell off here like this? Because how much money are they going to make? We already had UBS coming out and JP Morgan coming out and talking about how bad their trading is, how ugly their trade desks have been this year. Even though the market's up big, their trading is really taking a hit because things haven't traded as normal. Now, their core business, borrowing and lending, well, do they have incentive to borrow for a month and go lend for 5 years? No, they lose money doing it. I mean, they gain a little in the origination fees and all of that kind of stuff in the fee structure, but in general, they're losing money. They lend money out for 7 years, they're losing money. 10 years is pretty neutral. By the time you put in the credit risk and all of that, they're losing money. So the market looks and goes, wait a minute, what the Fed's doing is actually going to erode the earnings of the banks. For many, many years, it's been as go the banks, so go the markets, right? And anyone who's been trading in the markets for more than 15 years, that's hard to shake out. It's hard to shake off. But I think there's something very telling in this market that while we see tech and while we see other stocks going and pushing into new highs, we have banks which have some serious negative divergence. How healthy is an economy where banks are not making money? You combine that with some of the eroding economic data, there's some serious risks. Some absolutely serious risks. How do they get washed away? How do they get kind of explained away? Well, they get explained away by saying, oh, this is just happening because of China-U.S. trade. Just the tariffs, right? That's all it is. If the tariffs didn't happen, we wouldn't see this. And so, when a deal gets struck, all the data is going to turn around. It's going to be great. And you have those calling for huge market rallies based on that mentality. They ultimately could be right. But what about the Fed? What about the inverted yield curve? I mean, you have a market pricing in an absolute rosy picture for U.S.-China trade deal. They are pricing in that a killer deal is going to be struck. What happens if it's just kind of a partial deal and, you know what, by the time it all is said and done, some of the things really didn't get dealt with? I mean, what happens if a deal just doesn't happen? Can you imagine if a deal doesn't happen? Is the market priced for that? Banks don't care. Banks don't care about a China deal. That's not how they've been trading. They haven't been trading based on a China deal, U.S.-China deal. Banks are trading on this yield curve inversion. When the fears of inversion came in December, that's when banks flushed. When the Fed started talking a little more dovish, that, hey, you know what, we're not going to mess with the front end maybe as much. We're watching. We're with you. But now with the Fed taking this ultra dovish approach, when the Fed goes dovish, what happens to the yield curve historically? Historically, the yield curve inverts. Then the Fed has to react as the yield curve's inverted, as the markets are going down, as banks are losing money, as lending is tightening. Then you have the Fed. They lower rates and lower rates and lower rates and lower rates. Does it always work? Well, in the U.S., it always has. But you go look in Europe right now. What are their rates? They have the rates at zero. They've taken rates negative. What about Japan? They've taken rates negative. From a global economy standpoint, do they have room to continue to cut rates? I mean, the U.S. has created a little bit of room for themselves, the U.S. Fed. But other central banks around the world just don't have that room, don't have that space. It's a slippery slope. This isn't debt. This isn't credit. This isn't, some of those arguments. This is the profit centers of a global economy being undermined. Now, what's the bullish counter? The bullish counter is, look, banks aren't what they used to be. The world doesn't revolve around banks like it used to. The world revolves around tech. I mean, even Facebook, they're going to come out with their own currency. right? I mean, yeah, their own digital currency. They're going to turn into a bank. You go look at App Store or Google Play Store, and you go into different games or different programs. I mean, they've essentially created their own digital currencies. We're not talking Bitcoin and all of that. We're just talking within those individual apps. They create their own currencies. What happens as tech creates its own currencies? Is some of tech kind of taking the relevance of the banks a little bit away? It's one of the bullish arguments out there. It's a decent one. It's definitely a decent argument. But bottom line, this market has gone from as go the financials, so go the markets, to as goes tech, so goes the markets. And whether the yield curve is inverted, whether we see economic data continue to erode, whether we see profits continue to contract in the market, as long as Apple is going up, market's not going to go down. As long as Microsoft is going up, the markets are not going to go down. As long as Amazon continues to push higher, markets are not going to falter. Same with Google. As long as these tech stocks are strong, the market will remain strong. When these tech stocks break, what will happen? Well, the tech stocks have been the safe haven. The tech stocks have been the chasers, right? There where fund managers have some profits. But if those profits start to get eroded, now they're forced out. We are in an absolute market dynamic where fund managers are forced into the market. And while, I've talked with some bearish bias over the last little bit, one of the things that I've continued to say is, look, when you look at the incentives, the fund managers are being forced in. They're absolutely being forced in. They have to chase this. This is a historical start to the market this year. They have to chase it. They can't sit there like a trader and go, hey, you know what? I don't buy this move because of X, Y, and Z, so I'll wait it out a little bit. No, they have to chase it because they're a fund manager. And if their fund makes 2% and the market's up 20%, they're fired. They're done. The fund's going to lose a ton of money. So they have to chase in. And where have they been chasing in? They've been chasing into tech. They've been chasing into other areas. We have seen them this week go into some value plays. We have seen some of the most hated stocks in the market all of a sudden get bought up because, well, there's at least a little bit of relative value that fund managers can justify. So we are in that mode right now. The fund managers are being forced in. But while they're being forced in, while we have this kind of forced dynamic pushing money in, the clouds on the horizon are getting bigger. They're growing in a way that we have not seen in, I think you can argue, since 2006. Now remember, 2006, 2007, both very bullish years. Market didn't top till the end of 2007, right? So, risks don't have to be realized immediately. The short-term pressures are definitely to the upside. These long-term horizon clouds, they're growing. And they're getting louder. They're getting stronger. Are they big enough that they can't dissipate? No. They can still be dissipated. They can still be, chalked off. And this is, if you're massively short the market or saying, hey, you know what, I'm going to go mortgage the house and short the market right here, one of the things you have to worry about is the fact that these clouds do exist and are so strong because this offers another wall of worry to be scaled potentially here in the markets. This market isn't one of euphoria of, oh, there's no issues out there. Everything's great, grand, and wonderful. Things are just going to go higher forever. That's not what this market is. This market continues to climb a wall of worry, and those walls, or these walls of worry, I think actually increase this week. Bottom line for me, and as I look at this market, the long-term fundamentals of this market have been eroded over the last 3 months in a way that we have not seen in a long, long time. If this earnings season is weak by any stretch, we will see April and May turn into a huge drop in the market. Remember, that's an if. But we have a market whose longer term is eroding. But we have a market also whose shorter term incentives continue to be strongly bullish and strongly pushing on higher, and continue to push the fund managers in to the market. Ultimately, are there some stocks out there that I look at and I say, you know what, this is not what a bull market is built on? Yeah. Caterpillar action, this is not what a bull market is built on. Show me a bull market that's hit a new high that's been healthy where Caterpillar hasn't been participating. Doesn't exist. Doesn't exist. Show me a bull market that's been hitting a new high where U.S. Steel isn't strong. I think the last one you can go to where you can look at some of the major industrials, some of the major banks, some of the major economically sensitive stocks not really participating. You have to go back to 2000, the dot-com bubble. Now, we're not in a dot-com bubble right here. The companies that are going up, the Microsofts of the world, they have real profits. They have real revenues. They have real balance sheets. These are real companies that have been growing value, for a long period of time. These aren't just, flash in the pan. Hey, here's a website, and you know what? In 5 years, maybe we'll make some revenue on it to overcome the cost. Now, these are companies that are printing money. Apple is printing money. But for me, this is the environment we are in right now. We are in one where the longer-term clouds have grown, where the short-term euphoria has continued to be strong. The short-term incentives have continued to push things higher. And it's one where we haven't seen a dynamic switch in that just yet. Could we see one happen at any moment? Yeah, we could. When's the last time I think we kind of saw something like this that I remember being heavily involved in? Back in 2010. And, you've seen me go back to this time period a lot. 2010, this is one where, as we were fund managing, and we had a really good start to the year. And, we started the year with, let me get rid of Apple. We started the year with the market on the downside here. And, we caught some of this. We caught a little bit of this. And, we missed this last leg. But, we caught this reversal. They had one of these just classic high-volume reversal days, put the bottom in type of days, which, the market hasn't had a lot of, for a few years. But had one of those classics, and we rode the upside here through February and March. But as we looked at the data, as we looked at the issues, as we looked at what was going on, this was a time period where there were some rising clouds. And from Europe especially, Greece, Portugal, Spain, the pigs, so to speak. There, what a term. But Italy, some of the basically the Greek debt situation We saw some euphoria in the earnings, like, oh man, the earnings are so good right now and they can't ever get worse type thing. And, we started to position bearish and say, okay, you know what, we're taking our longs off, we're positioning bearish. And April was a rough month. It was a really rough month, right? I mean, as soon as we get a sharp down day, we'd start adding to a downside position, and boom, there's a 5-day pop. I mean, I know these don't look like long periods of time, but when you're going through them and you're heavily on the short side and you're going through them and you wake up and the market gaps down and you think, all right, here we go, and it just ends on higher, right? You start questioning. You start questioning yourself and going, oh my goodness, am I wrong? Am I just absolutely dead wrong? Then you get the little pullback and you think, okay, here we go. We finally got it. Oh, pop. You go through this for over a month. Right? You go through it for over a month here. These clouds didn't change. These clouds didn't get any different, right? The European situation was still what it was. But anyway, it's something that's, no fun to go on through. To me, this is, when I look at what's happening right now in the rally in the market, and I said to my brother, I said, it just feels like this. Just feels like this. And, I'm not in a fund managing position, right? Fund managing position, I can put on some trades, I can put on some long-term stuff and hold it. I can do some hedging, I can do a few things. With the challenge, I just got straight calls and puts and short-term calls and puts. So I have to get the timing right. I have to get the timing right. But I watch things trigger bearish. I watch them push on higher. I watch some of the kind of fundamental stocks. There are some of the stocks out there that have some of the most eroding fundamentals, get upgraded and upgraded and upgraded. And it's kind of, in the short run, I understand what the incentives are, but I would be very surprised if throughout the course of 2019 we don't go through a period like this that even potentially gets worse than this. We didn't have an inverted yield curve back here. Banks were big profit centers back here. In fact, all the banks, they were trading below book value, high yield curve. The banks were just trying to get some traction in terms of, people having confidence in their numbers again. When does this euphoria end? I don't think there's a good way to predict it. I don't think there's I don't think we can come in and put up a chart of the market and go, well, it's going to end right here at this and this and this. The euphoria, tends to end when we start to see the metrics shift. Today is the first day. Today is the first day where a day like yesterday has not been rewarded, or the chasers have not been rewarded. The chasers have been absolutely rewarded in this market over and over and over. Today's first day where they're not being rewarded so far. It's early, it's a 1% move. Chasers and Twitter are definitely being rewarded, right? Not as much as they were a little earlier, but chasers and Apple being rewarded. I guess Apple's just turned red. Chasers and Home Depot being rewarded, right? Talk about a stock that isn't stopping. Basically said, who cares about this gap, which is wow. Just wow. You just don't see that very often. But you do see chasers being rewarded in certain areas. But the erosion of the banks right now. When have we ever seen this big of a pullback in the banks not followed by a broader market pullback? Just doesn't happen. Just doesn't happen historically. So, as we go and we look at this market, these are my thoughts on it. This is kind of where I sit. As I mentioned yesterday, I have put on some sizable bearish positions on the market itself. I've bought some straight up IWM puts for July, and I bought some in the money SPY puts for August. And I went, pretty good in the money there. Sizable position. Does it mean I'm going to be right? No, it doesn't. But that's how I react. That's how, when I look and I go, okay, this is what's going on. This is where my bias, these are some of the concerns that I see, blah, 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 and all that. That's where I go, okay, you know what? That gives me enough time to let things happen. So I'm not staring at the market every minute, every moment going, is this the top? Is this the top? Is this the top? Is this the top? Right? And allows me to get some good downside exposure. And that's what I've done. Things that I hold for long periods of time, like Disney, I haven't touched and done anything different with it. It's same as it always is, and I'm not going to. And Disney may ultimately go to 50 in a bear market, but that's not something that I'll be messing with all that much here. But we have some real breakdown elements in this market, except for in tech and a few other small areas. And I do think it's a very dangerous market for the bulls in the longer to midterm here. But, it continues to kind of be a short squeeze environment for the bears. You look at the AMDs of the world, you look at the Microns of the world, you look at the Home Depots, you look at the Apples. There's been some massive short squeeze elements that have come into play. Now for the challenge. Does the yield curve matter? Does my long-term thought on the market matter? Does my short-term thought on the market matter? No, not really, right? It's a matter of getting the short-term timing on a trade correct. That's what it comes down to, right? This isn't that game of, oh, well, you know what, the yield curve is doing this and the market's doing this, so I'm going to set up this way for a long period of time. No. It's not. In fact, the stuff that I've set up to kind of hold for a bearish bias, just hasn't played out well. The XLY, took it on the chin with that. Home Depot taking it absolutely on the chin with this. Even if Home Depot drops $5, my option's not going to improve all that much. I mean, I need it for a really big wrecking ball here. When it comes to the challenge, it's a matter of the short term. And so I'm looking at, okay, where do we see some of the short-term breakdowns? Stinking Caterpillar keeps on running here. This is one that I saw here, this morning. Am I going to be as trusting to it? No. I mean, I paused. I sat on my hands. Even when I got on video, I sat on my hands for it. Why? Because I haven't seen short-term bearish triggers pay off. But you know what we're seeing over the last 2 days? Within the banks, within the Caterpillars, within the U.S. Steels, within some of the other things in the market, we're actually seeing some of these short-term bearish signals come in and actually pay off a little bit. Okay. Okay, starting to see that. That means we're going to see some more. And I expect that we will see some more. And I would rather play those than upside bullish signals. Valero. Talked about it yesterday. Nice little upside signal. Bullish continuation. Great volumes to the upside. It actually had some bullish elements and broke on down. Okay. Interesting. We're starting to see some of those out there. Here's Halliburton breaking on down here today. We're seeing some of these high volume moves from this week getting reversed. Now, if your watch list is all tech, you're not seeing that, right? But if your watch list is diverse and you have other things in it, you're absolutely seeing that here today, where some of the bullishness of the week is being reversed. It's not broad based. It's not everything out there in the market, but I do think that we may look back in a matter of months and go, this week, this was game changing. It was game-changing. And not because, the market's making a major pivot right here. Not because maybe the market never goes up from here. But I don't think that any gain in the market from this point on, I don't think we can say, hey, this level won't be retested again. This Fed level that we saw come in this week won't be retested again. So further rally, I do think is highly shortable, but the time frame has to be respected, and the understanding of what fund manager incentives are has to be respected. Think about fund manager today. How they feeling? How they feeling? The fund managers that have been forced in. Because the fund managers that have been forced in are not in the same position as the fund managers that jumped in. The fund managers that jumped in, you know what? They can start to trim. They don't have to worry about, hey, if I miss a little bit more in the market, no, I still have really nice gains. The ones that have been forced in, though, can they stay in if there's a little bit of a breakdown? No. They're forced in this over the last 2 weeks, and now the market breaks on down. They're in even a worse position. So they have to be more reactive. They have to be more sensitive and more adjusting than what they would like to be. And in many cases, that means they're actually being traders, not fund managers, being technicians, not fundamentalists. And, we saw a lot of that in 2007. We saw a lot of that in 2010. And I think we're seeing a lot of that here today. So anyway, those are my thoughts here on the long-term, short-term of the market, the yield curve and the yield curve implications here. And, we'll go from there. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.